Look at the Genesis block of the Morpheus network. The insider allocation is absolutely empty. There is no pre-mine and no venture capital subsidies. Most crypto infrastructure networks reserve 30 to 50% of their supply for early teams and investors. In Morpheus, every token in circulation exists strictly because someone provided verifiable compute, code, or capital to the system. This chart shows the total supply schedule for the MOR token. It operates on a smooth, heavily front-loaded exponential decay curve that approaches a strict hard cap of 42 million tokens. Because the curve decays over time, the absolute highest rate of token creation happens right at the start. In year one, the protocol mints exactly 14,400 tokens every single day. That daily volume doesn't go to a centralized foundation. It is divided into 5 distinct slices. 4 of these are equal 24% allocations. Those 4 main buckets go directly to the groups building the network: compute providers running the AI hardware, code contributors writing the software, capital providers supplying liquidity, and community builders. The final 4% slice is routed to a community-governed protection fund. This acts as an automated self-insurance mechanism to compensate users in the event of a smart contract failure. Releasing the majority of supply early to active contributors solves the cold start problem. It disproportionately rewards the participants taking the most risk in the network's first months, creating an incentive structure that drives adoption without relying on external venture capital. For capital allocators, participation starts on Layer 1. You deposit staked Ethereum, stETH, directly into the Morpheus Ethereum smart contract. Your initial deposit remains entirely under your control. The principal is never spent by the protocol, it's never sold, and after an initial 7-day lock, you can withdraw it at any time. The protocol only cares about the economic energy your asset generates. Staked Ethereum naturally generates around 3 to 4. Stablecoin lending might yield 7%, while staked Ethereum yields 3%. If rewards were distributed based solely on the dollar value deposited, stablecoin providers would receive the same token reward for contributing double the economic value. To fix this, Morpheus uses Chainlink oracles to monitor real-time lending rates across all accepted assets. The oracles convert all base yields into a single stablecoin equivalent. Your share of the token distribution is determined strictly by the actual yield you generate, not the sheer size of your deposit. This creates a permanent automated buyer for the token. Every day that capital remains staked, the protocol uses the generated yield to deepen its own liquidity pool, building an economic base without exposing the user's underlying capital to market volatility. High early token emissions inevitably cause aggressive dilution. If you hold a token while 14,400 new ones are minted daily, your percentage ownership of the network drops rapidly. Morpheus addresses this mathematical certainty through a mechanism called the power factor. It allows users to actively absorb that dilution over time in exchange for a systemic reward. This graph visualizes the power factor. By voluntarily locking your earned MOR tokens for a predetermined timeframe, you receive a multiplier on your ongoing emissions. It's a nonlinear curve that increases based on the length of your commitment. A lock of less than 6 months offers almost 0 multiplier. The curve only climbs when you extend the timeline, reaching a maximum ceiling at 6 years, which yields an emission multiplier of roughly 10.7x. These locks are executed at the smart contract level. Once you commit, the lock is absolute. You cannot withdraw the tokens early, and you can never shorten the duration. For a capital allocator, utilizing the maximum multiplier is mathematically optimal, provided you structure your position correctly. You deposit capital that you do not need to access for the duration of the lock, treating the multiplied illiquid token rewards as a long-term accumulation strategy. The power factor acts as an economic filter. It penalizes short-term participants who sell tokens daily, while directing the largest share of network ownership to users willing to make irreversible, multi-year commitments. Capital providers fund the network's liquidity, but compute providers are supplying the actual product. These are independent operators running AI hardware to serve inference requests across the network's Layer 2 API gateway. These node operators earn baseline revenue directly from the 24% compute emission pool. Their specific share is determined by verified uptime, hardware performance, and response latency. They can also earn revenue organically. A user running an on-chain session can pay a provider directly, settling the cost in MOR tokens per second of compute time used. However, the majority of network traffic doesn't use direct payment. Instead, users acquire access by staking more tokens into a builder subnet. Their staked balance generates a daily allowance of compute credits, which they spend to run AI models. The mechanics of this stake for access model obscure a critical reality. When a user spends their daily credits, their staked collateral remains securely locked. The compute provider is not being paid with the user's tokens. Instead, the provider is compensated by essential protocol treasury. This treasury is continually refilled by the 24% compute slice of the daily network emissions. In its current form, the stake for access model is an inflation-funded demand subsidy. It abstracts the cost of compute away from the end user to rapidly build initial network traffic. Because the year-one emission rates are extremely high, the treasury accumulates tokens far faster than current network usage depletes them. The smart contract enforcing a 1% cap on daily settlement means this subsidy has a runway measured in years, but that runway is mathematically finite. After roughly 16 years, token emissions drop to structural tail levels. When that cliff hits, the inflation subsidy breaks. The network will have to transition entirely to direct user payments or implement a new fee redistribution model. The subsidy is an effective tool to remove friction and acquire an initial user base, but it is not a perpetual motion machine. The network's long-term survival rests on its ability to cultivate genuine, paying demand before the emissions run out. To generate that genuine demand, Morpheus relies on a specific technical moat, hardware-level confidential inference through trusted execution environments. By utilizing isolated hardware components like Intel TDX CPUs, a compute node can cryptographically prove that it is running the requested AI model without ever logging or exposing the user's input data. This enables highly regulated workloads to utilize decentralized AI. Financial institutions, medical providers, and sovereign entities legally cannot send sensitive data to centralized corporate APIs, but they can securely route it through an audited, trusted execution environment. This specific capability drives structural token demand. To access these secure nodes, enterprise users must acquire and hold more to generate the compute credits required for network access. This chart shows how the protocol manages the token supply over the long term. The burn mechanism operates independently of compute demand. It is strictly tied to the yield diverted from capital providers. Of the tokens generated purely for liquidity purposes, 50% are permanently destroyed. The remaining 50% are locked away in a multi-decade reserve dedicated to funding future tail emissions. When those tail emissions activate after 16 years, they are strictly capped at exactly half the volume of tokens burned during the previous period. By hard-coding tail emissions to remain strictly lower than the historical burn rate, the architecture guarantees structural deflation. The total supply mathematically contracts as long as capital remains deployed in the liquidity engine. There are 3 macro scenarios to evaluate. In the bull case, enterprise adoption forces massive supply to be staked, while liquidity generation deflates the float. In the bear case, demand fails and emissions outpace utility, trapping allocators holding a depreciating asset. This scenario also factors in technical risk. Executing yield capture on Ethereum, distributing rewards on Arbitrum, and managing inference on Base requires a highly complex multi-chain architecture. Professional audits flagged medium-severity risks in the smart contracts handling these cross-chain capital flows. The realistic case is a slow, organic adoption curve. Early emissions provide significant yield, but the financial advantages isolate to those utilizing maximum lock durations to offset ongoing inflation. The determining factor in this middle scenario is whether Morpheus can capture meaningful enterprise market share against established, heavily capitalized decentralized compute networks. The ultimate protection for a capital allocator is the structural isolation of the underlying asset. Even in the worst-case scenario, the foundational principal deposit is fully protected, liquid, and entirely withdrawable at any time. The Morpheus protocol rejects the fast, artificial growth of venture capital. It replaces it with a strictly codified, math-driven engine designed to forge long-term alignment, pushing the real risks away from insider dumping and squarely onto the timeline of actual operational execution. This analysis is from Own Your Mind, an independent research platform covering decentralized AI. They operate with no sponsors.